For years, a powerful story kept silver prices in a box, a story of a strong dollar, of a Federal Reserve in complete control. But what happens when that story suddenly falls apart? What happens when a quiet, fundamental truth about our financial system is exposed for everyone to see? Welcome to the Bullion Signal Podcast, the channel where we look at the big picture for your wealth, focusing on gold, silver, and the macroeconomic forces that shape our world. Today, we're not just looking at a price chart, we're dissecting the exact moment the game changed for silver. We're talking about the convergence of two massive forces, a stunning policy reversal from the central banks and a physical market that was already stretched to its breaking point. This is the story of silver's great escape. Let's get into it.
It all really starts with this one powerful idea. You won't hear a central banker say this out loud at a press conference, of course, but their actions are screaming it. The system, as it exists today, simply cannot function on its own. It needs constant, permanent life support. What used to be sold to us as a temporary emergency measure, to get through a crisis, has now become a permanent feature. And once you truly understand that, once you realize that the system requires endless intervention just to stay afloat, it changes your entire perspective on what real money is. This single admission, made through actions, not words, is the spark that lit the fuse for precious metals. So, to really get a grip on how big this shift is, we have to rewind the clock just a little bit. For what felt like an eternity, the market was dominated by one simple mantra: higher for longer. The idea was that the Federal Reserve had inflation on the ropes and was going to keep interest rates high to finish the job. This narrative was incredibly powerful. It propped up the US dollar, and as a result, it acted like a heavy blanket on hard assets like gold and especially silver. As long as everyone believed in that story, there was very little reason to run for safety. But in late 2025, that entire narrative wasn't just challenged, it was utterly demolished. And the event that demolished it was what we can only call an emergency pivot. This wasn't a gradual, well-telegraphed shift in policy. No, this was a sudden, screeching U-turn that was so aggressive it sent a shockwave through the markets. You see, when a central bank moves that fast, it's not a sign of strength or control. It's a signal of panic. It's an admission that something is seriously broken just beneath the surface, something far more dangerous than the inflation they claim to be fighting. The market read it for what it was, a giant flashing red light signaling profound systemic weakness. Just look at the speed of this reversal. This timeline is absolutely staggering. On December 1st, the Fed slams the brakes on quantitative tightening. That alone is a big deal. But then, just 9 days later, they hit us with the third interest rate cut of the year. And before the market could even fully digest that, 2 days later, they announce a brand new, massive Treasury purchase program. Think about that for a second. In less than 2 weeks, we went from a policy of tightening, of pulling money out of the system, to aggressive, open-ended easing. That's not a pivot, that's policy whiplash. And it screamed one word to Wall Street: emergency. Let's really focus on this number, 3. You see, one interest rate cut can be explained away. It's just a little tweak or an adjustment. But 3 cuts in a single year? That's a completely different animal. That is a clear, unambiguous signal that the Fed's priorities have been turned upside down. They effectively abandoned the fight against inflation. Their primary mission, their only mission at that point, became preventing a catastrophic economic downturn, and they were willing to print whatever it took to do it. And this was the real game changer. This is where the rubber meets the road. $40 billion. Now that's a number that's so large it can be hard to wrap your head around, so let's put it in perspective. We are talking about $40 billion of new currency being created out of thin air every single month, specifically to buy government debt. Annually, that's almost $500 billion. This isn't just a liquidity injection, it is a fire hose of currency aimed directly at the heart of the financial system. And when you unleash that kind of monetary force, you have to ask yourself, where does it all go? What does it do to the value of the dollars already in your bank account? It's a move that is guaranteed to have massive, far-reaching consequences.
Now, of course, the officials had to give it a nice, sanitized name. They called it a technical intervention. They went out of their way to insist that this was not another round of quantitative easing, or QE. But here's the critical thing you have to understand. The market doesn't care about semantics. It doesn't care what you call it. The market only cares about function. And when a central bank digitally creates currency to buy up government bonds, that is balance sheet expansion. It's QE. The function is identical, and the end result is always the same, a massive increase in the currency supply.
So let's just step back and summarize what happened here on the monetary side. You've got two powerful forces hitting at the exact same time. First, you have falling interest rates. This makes holding dollars less and less attractive because you're earning next to nothing on them. And at the very same moment, the Fed is cranking up the printing press, massively expanding the supply of those very same dollars. It's a direct, undeniable, two-pronged attack on the purchasing power of every single dollar in existence.
Now, if this were just a story about monetary policy, it would be a huge deal in and of itself. But it's not. What makes this situation so incredibly potent, so explosive, is that all of this monetary rocket fuel we've just talked about was poured onto a fire that was already raging. And that fire is a deep, long-term structural shortage in the physical silver market. This is the other half of the equation, the one that many people miss, and it's absolutely critical.
And this chart really tells the story. This deficit isn't some new development that just popped up. For 5 straight years, that's half a decade, the world has physically used more silver than all the miners on the planet have been able to pull out of the ground. This isn't a one-off event or a statistical blip. It is a fundamental structural imbalance that has been quietly draining visible inventories and building up immense tension in the physical market for years.
And the scale of this shortfall is just mind-boggling. In the year 2025 alone, the gap between what we used and what we mined was over 200 million ounces. Let that sink in. A 200 million ounce deficit. And that came on the heels of 4 previous years of deficits. This is why available stockpiles, the silver sitting in vaults in London and New York, have been relentlessly drawn down long before the Fed ever started talking about rate cuts. The physical tightness was already there. So, the big question is, why? Why is this deficit so stubborn? The answer lies in where the silver actually goes. A whopping 60% of all silver demand is industrial. This is what makes silver such a different animal from gold, where investment is the main driver. Industrial demand means the silver gets used up. It gets consumed in products, it's often not recycled, and it's effectively gone forever. This creates a constant, relentless, underlying demand pressure that simply doesn't exist for gold in the same way.
And here's the most important part about that industrial demand. In economics, there's a term for it, price inelastic. All that really means is that demand doesn't really change much, even if the price goes up. Why? Because we're talking about absolutely essential, non-negotiable applications. Think about solar panels, electric vehicles, smartphones, 5G cellular networks, all sorts of electronics. For these critical technologies, silver is irreplaceable. There is no substitute. And the amount of silver in each product is so small that even if the price of silver were to double or triple, it would barely affect the final cost of a car or a phone. So these industries, they need the silver, and they will pay whatever it takes to get it. It's not optional.
Okay, so this is it. This is the moment of ignition. You have 2 incredibly powerful forces that have been building independently, and now they are crashing into each other. On one side, you have a physical market that is stretched incredibly thin, strained by 5 years of continuous deficits. And on the other side, you have the Federal Reserve kicking down the door and flooding the world with new currency. This is where monetary demand collides head-on with physical scarcity.
For any investor, for anyone trying to preserve their wealth, the equation suddenly becomes painfully simple. The dollar in your savings account is getting weaker by the day because the supply of it is exploding. At the same time, if you own government bonds, the interest you earn is less than the real rate of inflation. That's called a negative real return. It means you are literally losing purchasing power. So holding cash is a losing game, holding bonds is a losing game.
And when both of the world's primary safe assets, cash and bonds, become guaranteed losers, what happens? It creates the perfect storm for hard assets. It forces capital to flee. It forces people to look for a safe harbor, for something real. Something that can't be devalued by a central bank's keyboard. It ignites a frantic global search for real value. And physical silver,
the most undervalued hard asset on the planet, finds itself right in the eye of that storm.
The market's reaction on a technical level was almost instantaneous. The price of silver broke out above a critical resistance level, a ceiling that had held it down for more than a decade. And this breakout is showing all the classic signs of a short squeeze. That's when large traders who have bet against silver are suddenly forced to buy it back to cover their losses. But their buying just pushes the price higher, which forces more short sellers to buy, creating a vicious, self-reinforcing feedback loop that can send prices parabolic.
I want to be clear, though. What's happening here is so much bigger than just a technical price move on a chart. It's a fundamental, psychological paradigm shift. The Fed's panicked pivot is being seen by the entire world as a clear admission that the system is fragile and that their only tool is the printing press. And in a world like that, silver's role completely transforms. It stops being just an industrial commodity, and it reclaims its historical role as an essential monetary metal, a financial lifeboat in a gathering currency storm.
We can also use thousands of years of history as our guide here. The gold to silver ratio is a very simple metric. It just tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is around 67 to 1, which is extremely high by historical standards. In every single previous precious metals bull market, this ratio has collapsed. If it were to simply return to a more historically normal bull market level, say 25 to 1, that would imply a silver price well into the triple digits, even with gold staying where it is today. It just shows you how incredibly undervalued silver has been.
And I'm going to say this one last time, because it is the absolute bedrock, the foundation of this entire move. This is not just about paper contracts or futures markets. The explosive upward pressure on the price is fundamentally supported, it's backstopped by a real, tangible, verifiable shortage of the physical metal. That 5-year-long deficit provides an incredibly solid floor under this market. You can print infinite dollars, but you cannot print physical silver. Ultimately, it really does all come down to this. For decades, people who held physical gold and silver were told they were crazy. They were told they were fighting the Fed. But with this emergency pivot, with the admission that the printing press is the only tool they have left, the Federal Reserve has single-handedly validated the entire thesis for holding hard assets. They lit the fuse themselves. They gave the entire world the reason to start searching for real, tangible value. Which brings us to the final critical question. On one side of the scale, you have an unstoppable force, unprecedented monetary demand, unleashed by a central bank that has no other choice. And on the other side, you have an immovable object, a physical market starved of supply after half a decade of deficits. So when those two forces collide head-on, what happens next? I think we are all about to find out. Thank you for joining us on the Bullion Signal Podcast. If you found this analysis valuable, please make sure to like, subscribe, and share it with someone who needs to hear it. We'll be back soon with another deep dive into the signals that matter for your wealth. Just a quick reminder, this content is for informational and educational purposes only. It is not financial or investment advice. You should always conduct your own research and consult with a professional before making any investment decisions. You are solely responsible for the choices you make.